Welcome back. Let's invite the next corporate on trading. Our SIS Limited is the company which is on our radar. This is a company which provides security services, basically a watchman, the security staff to banks, hotels, IT companies, residential colonies. So they get their revenues from the security services both in India as well as the international market. But the international market is predominantly the Australia region. They also have about 13-15% of their revenues coming in from the facilities management. In this, the company will provide, say, a receptionist, lift operators, janitor services to a hotel and other sectors. So this is what the company does, and they reported their Q3 earnings. There has been a 10% growth in their revenues, but margins have come under pressure. We're now joined by the company's managing director, Rituraj Sinha, on the show. Rituraj, morning. This is Rima here. Good to see you. It's been a while since we chatted. If you could talk first about your margin performance. You did indicate that the operating margins were impacted by a few one-offs, like the vaccination cost. There was some one-time, expenditure, expenses on your employees, and X of that, margins were at 5.4%. But this is still lower than the pre-COVID levels of nearly 6% that you've enjoyed. How soon can you get back to 6% EBITDA margins, and what will lead to that?
Well, Rima, it's good to be here. Thank you very much. I think if you look at the SIS result this quarter, it is our highest ever quarterly revenue at 2,600 crores. And clearly the company is back to growth. And this is not just the security vertical, but also the facility management vertical, international vertical, and the cash logistics vertical. All four of our service segments have reported highest ever revenues this quarter. So it's a very secular growth. As regards to margins, it looks compressed because of certain one-off charges of 5.1 odd crores, which are sitting in Q3 books. If you do an apple-to-apple comparison, our margin is not 5%, but closer to 5.3, 5.4%. And we are very much on track to go back to pre-COVID levels of 5.5-6% ballpark.
Hi Rituraj, good morning and thanks for joining us. This is Pavitra. I want to ask you specifically about the facility management business. That one seems to have done quite well. It's up 30% on a year-on-year basis. But there were some customers which sort of have delayed full-scale operations, right? Can you take us through how many of them have sort of done this delay, and what is the outlook over there? Do you see some return there in the near future?
Well, the beauty of the SIS business is that we are completely an essential services provider, which basically means that, through the lockdown period, through the disruption of second wave, third wave, we have certain sectors that reduce volume because, hospitality was down, IT was working from home, so they didn't need the services. But similarly, healthcare needed more services, for example. Several other segments like manufacturing, e-commerce needed more services. So the beauty is that it's essential services, it's customer segment agnostic, and that's the reason why, facility management has come back with the highest ever revenues, despite the fact that we are, in the midst of a third wave. And mind you, even in FY21 last year, we reported 7% year-on-year revenue growth. And if you look at 9 months of this year, we are on track to report close to 10% revenue growth this year, despite the first quarter being wiped out by second wave and the third, fourth quarter being impacted by the third wave.
Hi Rituraj, morning. For your India security business as well, things look to be improving, right? I think in Q3, you have gotten new wins of about, 20 crores. Can you give us a sense of, how much higher it could head from here, and what will be the new run rate like?
Well, we are run rating, close to 850 crores a month right now. So clearly the trajectory is 10,000 crores plus on an annualized basis. The new order pipeline is strong in security. We're getting great traction from manufacturing, great traction from e-commerce and other segments like that. In facility management, we witness a very big change. I think customers today are prioritizing their expenditure on hygiene. Hygiene has become a safety issue more than just cleanliness. And therefore, we see malls, retail establishments, corporate parks, IT establishments willing to spend far more on hygiene, with better quality equipment, material, etc., than they were prepared to pre-COVID. So overall, I see, a very strong traction both in security and facility management. And like I said, we are the second largest cash company in the country. And our cash business has been very resilient through the last 24 months. It has continued to report its highest ever revenue last month. So I think all engines firing for now.
It's an important point, right? Companies are increasing their spend on hygiene, on cleanliness, which of course is a positive for your facilities management business. So in Q3, facilities management revenues went up 30% on a year-on-year basis. Can you sustain this growth rate? And how much higher has it gone up, your demand, in terms of, say, the number of people that you employ or the pricing that you get?
Well, I think the best way to look at this is, SIS is closing on 5 years since we got listed. And the 5-year, despite COVID, GST and demon impact, this 5-year patch, our growth rate on security has been more than 20% for a 5-year CAGR. Our growth rate for facility management over the last 5 years is more than 30%. So we remain very bullish, and we've sort of said this in the past that SIS, in terms of guidance, talks about a 20% year-on-year revenue growth and a 20% return on equity with a 50% plus, OCF to EBITDA. So those are the three metrics we track. COVID has obviously tapered down our growth. We did 7% last year. We are looking like 10% this year. But going forward, once we are out of the woods, our goals are clearly set. We are looking at 20% plus revenue growth over the coming years once COVID is behind us.
All right, Rituraj, we'll leave it at that. Thank you very much for joining us. A 20% growth over the coming few quarters. That is the word coming in from the management. That's the kind of growth that they expect to clock in.